Let's take a look at the Chapter 2 exercises. So I have our ebook open. I went to the computational exercises for Chapter 2, and we'll just go through and work on them together and solve them together. I like to use Excel, so I've got Excel open in the background. We'll just jump between Excel and the ebook to solve the problem. So the first one we'll take a look at is problem 15, and it says here that in 2019, Megan Carlson, single taxpayer, has a QBI of 110,000 and modified taxable income of 78,000. It's also her taxable income before the QBI adjustment. Given this information, what is Megan's QBI deduction? So it's 110 and then 78. So we'll kind of drop in those two numbers. Okay, and the rules are that she uses the lesser of the two. So if you can recall from the PowerPoint, there's a threshold limit, and the limit for singles is different than it is for married. So it said she's single, and so her limit, let me put this over to the side here, is the limit for singles is 160,700, and so the two numbers they gave us the QBI, and so they just said it's 110, and they said that the modified taxable income, so modified taxable income, MTI, modified taxable income, is these two amounts. So I have to multiply each one by 20%. So I'm just going to put in 0.20 for each. I'm going to multiply them by each other, and we'll see what we get, and we'll go from there. So I get 22,000. Or I get 15,600, which is the number right here. Well, the way the rule works, it's the lesser of. So the deduction is the lesser of the QBI or the modified taxable income. So therefore, the answer for question 15 is $15,600. Okay, so question 16 is the next one. It says here that Charlotte is a partner and sales manager for CD Partners, a domestic business. That's not a specified services business. During the year, she received guaranteed payments of $250,000 from CD Partners from her services to the partnership and its sales manager, as a sales manager. In addition, her distributive share of CD Partners' ordinary income, its only item of income or loss, was $175,000. What is her QBI? So one thing to keep in mind, and the chapter mentions this and the PowerPoint mentions this, is that guaranteed payments are not included. Okay, so guaranteed payments do not qualify for the QBI. What does qualify is qualified business income. So her qualified business income is the 175. Okay, so the 175 is the answer. So our QBI is the 175, not the 250, because the 250 is a guaranteed payment. Okay, question 17 is next. It says that Robert is the sole shareholder and CEO of ABC Inc., an S Corp. That's a qualified trader business. During the current year, ABC has net income of $325 after deducting Robert's $100,000 salary. In addition to his compensation, ABC pays Robert dividends of $250. So part A is, what is Robert's qualified business income? Okay, and so his qualified business income is the net income. Okay, it's the 325, which is the net income right here. Part B, would your answer to part A change if you determine that reasonable compensation for someone with Robert's experience and responsibilities is $200,000? Why or why not? The answer is yes, it would change. So reasonable compensation was $200,000. Then $100,000 of the dividends would be reclassified as compensation. Okay, so this you can see right here the dividends was $250, and so he already made $100,000. So what would change is $100,000 would come off of dividends and go to his salary. And so salary would become $200 and dividends would become $150. So once his dividends or once his salary goes up, that will change his net income. So the net income will go from 325 down to 225. So his net income was 325 and would go to 225, and his QBI would now be 225. Okay, so it would change. Question 18. Maria and Javier each have 175 of, I'm sorry, read the wrong thing. Maria and Javier are equal partners of Marja, a partnership that is qualified trader business. In the current year, they had 350 of ordinary income after reporting 500,000 of guaranteed payments that they split at 250 each. And this is for their services to the partnership. So part A, what is their qualified business income? And they're obviously splitting things equally because you've already kind of established that by saying 250 each for the 500,000, so it's 175 each. So 18A is 175 each. B is, how would your answer change if Marcia had 550 of ordinary income after reporting the 300,000 in guaranteed payments to Javier and Maria at 150 each? And the only real difference is we just take the 550 and divide it by 2, which is now 275, because guaranteed payments do not factor into that. Okay, so it's a payment that's guaranteed. It does not go into determining what the QBI is, so the answer just becomes 275. Okay, question 19 is about Thad, and he's a single taxpayer. He has taxable income before a QBI deduction of $190,700. Thad's a CPA, operates an accounting practice as a single member LLC, and he is basically then a sole proprietor of that. He's the only owner. During 19, he generated qualified business income of $150,000, W-2 wages of $125,000, and $10,000 of qualified property. What is his QBI deduction? So remember that one of the specified services businesses was accounting. So early on in the chapter, when we talked about QBI, we talked about some businesses are specified services, and they do not get the entire deduction. They still get something, but not all of it. And that's what accounting would fall under, that category. So part of it is we have to figure out what his applicable percentage is. And so to do that, we'll have to look at the numbers given to us. So let's take a look at the QBI deduction. Taxable income before QBI was $190,700. And then I subtract from that the limit. So we'll go back to here, and this will be for question 19. And so he had QBI, and the amount that they gave us was the $190,700. Okay. So from that number, I subtract the limit for being single, the $160,700 right here. So the net number is $30,000. Okay, so the $30,000 is what's left over. Now what I can do then is apply that to a percentage. And the percentage is, I have to go back to the numbers and take a look here, and we go his wages was $62,500, so we have to kind of take a look here at some of the amounts they gave us. And here's another little kind of a tricky thing. So I have to look at that W-2 wages of $125,000, and part of the rules is there's a 50% amount of this is what we're allowed to use. So we can use half of his $125,000, and that gets us to $62,500. And then so the part about his wages of $125,000, there's a 50% limit on that, which is $62,500. That amount will exceed the other QBI deduction computation, so we don't have to worry about that. But let me go back to the Excel, and so his limit as a single person is $160,700. However, there is a cap on QBI of $210,700. So I'm going to put in the cap, and that is $210,700. Okay, that's the most the most QBI that you can have, as depending on what your tax bracket is. So as the high wealth one is $210,700. And so the difference between the two, between that cap and the single limit of 160,700 is 50,000. Okay, so I just wanted you to kind of see that. So the numerator to compute his percentage is this number here, 30,000 divided by 50,000. So you start out with 100%. I'll just say 1 is 100%. And I then subtract from that the 30 divided by the 50, which is 60%. And I subtract the 100% minus the 60%, and his QBI deduction then is 40%. Okay, so that's what he's allowed to do, is take 40%. So his business deduction then is, going back to the problem, is qualified business income is $150,000. And so we take the 150. Okay, so let's put this down here. That is his QBI of 150. We multiply that by the 20% QBI deduction. So we take 150 times 0.2, and his maximum is 30,000. However, because he's in a specified service business as an accountant, he can only take 40% of that. So the same 40% we just computed here will be used to compute what that would be. So we can take 30,000 would be the full QBI deduction, but he only gets 40% of it. So his QBI deduction is $12,000. Okay, so the numerator of the formula is the 190,700, okay, minus the 160,700. So the 190,700 was this number right here, minus the single limit of 160,700. So that's the numerator. The denominator is the cap, that's the high wealth individual cap, minus the single amount for 50. And so the 30 divided by 50 is 60%. So 100% minus the 60% is 40%. That's what he can do, what he can deduct. So we can take 40% of the QBI. The QBI is 30,000. He gets 40%. So he can deduct 12,000 from his income when he computes his tax return. Okay, so that was a longer one, but I just wanted you to see how we get to that. Okay, question. The next question we'll take a look at. I'm going to skip 20. We're going to go to 22. Is right here, and this one is Ellie and Linda. They are equal owners of Otter Enterprises, a calendar year business. During the current year, Otter has $320 of gross income and $210 of operating expenses. In addition, there's long-term capital gains of $15. It makes distributions to Ellie and Linda, $25,000 each. Discuss the impact of this information on taxable income for Otter, Ellie, and Linda if Otter is a partnership, a corporation, or a C Corp. And you can see here, let's kind of go through each one, and we can then kind of understand. So for letter A, that's a partnership. So remember, as a partnership, Otter is the business. It's not a tax-paying entity. It's a pass-through. And its profit and loss of separate items flow through to the partners. Okay, so take a look at the numbers here. Revenue of $320, expenses of $210. That means they have income of $110,000, and that $110 then goes to the Form 1065, and ultimately ends up on the K1 split, however they split their revenues and expenses. The partnership also has the $15,000 capital gain. It's a separately stated item on Form 1065. And so the purpose of that is they each would get their half of that, $7,500, reporting in their own return. The reason it's separate is because we don't know what their tax situation is for Ellie and Linda. They're in either the 0, the 15, or the 20% bracket when it comes to long-term capital gains. And so the partnership doesn't know that necessarily, so it goes on the K1. So the partnership itself never pays tax. As a partnership, they get the owners, Ellie and Linda, get the K1. That'll show half of the profits and show separately stated the capital gain. So part B is if they're an S Corp. And again, an S Corp is not a tax-paying entity. So same thing as a partnership. The separate items flow through to the shareholders. And the S Corp will file a Form 1120S, and of course it'll still report profits of $110,000, and it will show that capital gain as a separately stated item, and again split that down the middle. So it's very similar. That the tax effect is extremely similar between the two. Okay. And then the last one, if Otter is a C Corp. Now, if they're a C Corp, that means that Otter is paying tax. So Otter would pay tax on the net income and the long-term capital gains. So they'd have net income of $110,000 plus the capital gain of $15,000, and they'd pay the flat tax on that. The 21% flat tax would be paid on that. Ellie and Linda would report dividend income because they each received distributions of $25,000, and then they would pay dividend income based on whatever their tax rate is of 0, 15, or 20. And also to keep in mind, under the sole proprietorship, under the partnership and the S Corp, those distributions, they're not taxable because they are withdrawals from the partnership. So under partnership and S Corp, when they receive the $25,000, it's not taxable, but it does reduce the basis in the business, and that will become important in future chapters. As a C Corp, when they receive dividends, then that did become taxable. Okay, so that was question 22. Let's take a look at 23, and this is for Purple Corp. Purple has $200,000 of net income for 19 before any deductions for compensation or payments to its sole owner, who is Kristen. Kristen is single, and she claims the $12,200 standard deduction in 2019. So on your personal return, you get that standard deduction. And Purple is Kristen's only source of income, ignoring any employment tax considerations. Compute Kristen's after-tax income if Purple is a proprietorship and Kristen withdraws $50,000 from the business, and she has a $37,560 QBI of income, deduction for qualified business income. Let's do that one first. Let me just scroll down to some new numbers here. So some blank here. We'll do question 23, and so now they are for part A, they are a proprietorship, so it's just her that owns it and nobody else. So her income would be $200,000. Okay, so go back and just see where the $200,000 comes from. This is right here, net income, and then from that net income number, we're going to do deductions. So this is kind of her personal return, right? So her business will file a Schedule C that shows it made $200,000 worth of income. So that's going to go through to her personal 1040, and then she gets deductions. So she gets deductions for two things. She gets her standard. That's just on a personal return because she's a single taxpayer, $12,200. Then she also gets her QBI. And they actually just gave us the number. They just said it was $37,560 right here. So minus $37,560. So her taxable income then, I'll just say TI for taxable income, is the sum of all three amounts right here. So the 150, 254. And then we have to compute the tax. So we have to go to tax tables to figure that out, which is in Appendix A of the book. So if you want to find that, it's Appendix A. I'm just going to go ahead and drop in the number. So her tax on that then is $32.32, and then her after-tax income, so ATI for after-tax income, is her $200,000 of income minus the tax she pays, and she gets $169,768. Okay, and then let's do Part B of that, and Part B says now they're a C Corp, and the corporation pays out all of its after-tax income as a dividend to Kirsten. Okay, so now this is Part B, which is they're a C Corp. And so net income again is $200,000, just like it was before. Okay, and now we're going to pay tax on that as a C Corp, and that's at 21%. So we'll just take the 200,000 times 0.21, and they'll pay tax of 42. So the after tax is the net, which is this number right here. I should make this be a negative. That would look better. Okay, so I get down to 158. Okay, so now they're going to dividend all of that to Kirsten. So she's going to receive a dividend now. So this is the corporate return right here. After tax of 158, it pays tax of 42. Now Kirsten is going to receive that on her personal return. And what she would get, she'd get the 158,000 minus the standard deduction of 12,200. Okay, so she's going to have taxable income then of 145,800. Okay, and then again we would have to go to figure out what her that's dividend income. So personal income is dividends, right? She receives as a dividend, and so she deducts the $12,200, and now she's got to pay dividends on 145,800. And again, the way this works is the percent you pay is based on your income, and so remember it's kind of that 0, 15 to 20 amount. And this is how that works. So up to $39,375, she pays 0%. Okay, so it's 0 for 0%. And then for $100 of that, she'll have to pay 15%. I'm sorry, 12%. So a bit of 0.12. Then the rest of it, the 145,800 minus what she's already taxed on, the 39,375 and the 100, that's what's left over, is 106,325, and she'll have to pay tax at the 15% rate. Okay. So let me just highlight these so we can see the actual numbers here. So our tax is going to be all these numbers multiplied by each other. Okay, and so she's going to get 15,961. Okay, the sum of these two numbers is 15,961. So that's how that works. We pay 0% on the 39,375, 12% on the 100, and then 15% on what's left over. So her tax then is the 15,961, the sum of these two numbers, and that's her tax. And then her ATI, after-tax income, is the difference. It's the 158 minus the tax that she pays. Right there. So she gets 142,039. So after-tax income there versus here. And then part C of the question says Purple Company is a C Corp and the corporation pays Kirsten a salary of 158. Okay. So if they do that, notice that they have 200,000 net income. They pay her a salary of 158. That means there's $42,000 left over. Okay, so under part C, this is that's a C Corp. They'll have that 200,000 of income minus what they pay her as a salary of 158. So that's left over is 21,000. They'll pay tax at 21% on that, and they'll have tax of 8,820. Okay, so that would be the tax at the corporate side. Kirsten then herself would have to pay tax. So she's going to receive 158 as salary, and then she'd subtract from that the 12,200 standard deduction. So her taxable income is the 145,800, and her tax based on the tax tables would be 29,167. Okay, so then her after-tax income is the 158 minus the 29,167 in tax, her after-tax income is the 128,833. Okay, so that's the differences between the two. So how the business is set up as a proprietorship, as an S Corp, and as a C Corp matters, especially with just her as being the sole proprietor. So her after-tax income changed dramatically between the three. Okay, so she was best off at this point right here. Okay, so that was question 23. We'll take a look at one more question. Question 24. And it says here, Shelley has $200,000 of QBI from her local jewelry store as a sole proprietor. Her proprietorship paid $30,000 in W-2 wages and $20,000 of qualified property. Her spouse earned $74,400 for wages as an employee, and they earned $20,000 of interest income during the year. And they filed jointly using the standard deduction. What is their QBI deduction for 2019? So remember, it's the lesser of, and we can go back and show you what it's the lesser of the qualified business income or the modified taxable income. Okay, it's always the lesser of the two. So let's go back to the problem, and you can see here that the QBI here was $200,000, and then her modified taxable income is the modified taxable income is the $200,000 plus the $30,000 plus the 20 plus the 20. Okay, so 20 plus 20 is 40 plus 30 is 70. So their MTI, modified taxable income, is 270. Let me just go down here and I'll plug this in. So 270 of MTI and 200,000 of QBI. Okay, so remember they get the lesser of 20%. So multiply those out, and they get the lesser of these numbers right here. So 40,000 versus 54,000, and the winner, of course, is the $40,000. Okay, so that was the questions that I wanted to go through with you for the week. If you have questions, as always, let me know. I know it's kind of painful to read a tax chapter, but there's really good information in there. There's really good examples in the chapter. So make sure you read through it and look through the examples, and then you can use those examples to help you with the problems. Okay, thank you.